In this video, traders, let's have a look at how wide we should maybe have our stops in the current market conditions. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. All right, so current market conditions are wild, to put it mildly. We're in 1,000-point moves in the Dow very frequently. Crude oil slamming around 10% moves, stocks doing the same, currencies swing. It's just crazy. Coronavirus is obviously fueling this and all the kind of fallout from that. So from a technical and trader's perspective, how do we know how wide to put our stops, especially when the volatility is so broad? Well, at the end of the day, guys, we have to use the rules that we have in place in our trading plan that were working well for us before all this, and just kind of extend them, adjust them, tweak them to include the current conditions and the current volatility. So if you were, let's say we're trading, and actually a trade that I've done very recently, let's use this as an example. Market's kind of gone down, pushes back up, tries to push up, fails a little bit. Then what we would normally do is, if we're looking for the short trade here, we're going to put our stop above that level as it breaks through. So if we kind of zoom in on this a little bit, we get the rally up, we push through, we come back in the classical trade, and one that I've shared with you many times before on the channel, and one that I take very frequently. It's probably one of my most popular trades at the moment, is selling as we come back through that high and then having a stop above. Now ultimately, it doesn't matter the order of magnitude of the stop. In previous conditions a month ago, if I was trading the Dow, that might be 50 tick stop, if that. It might be, depending on obviously how big the move and stuff. It's not going to be that big, especially if I'm taking it intraday. That's an intraday move based on a prior high, etc. It's not that big. Today, it could be 300 points, 400 points, 500, 600, it could be that order of magnitude. So it makes no difference. I just, of course, have to adjust my position size, and you just have to adjust your position size depending on how wide the stop is. It's almost irrelevant, the actual number, but what is relevant is how much money you're willing to risk on the trade. Let's say, if in weeks ago you were prepared to risk $1,000 on that trade, then you're probably still prepared to risk $1,000 on that trade. Now, some people dial it up and down depending on how good the setup is, but use that as a benchmark. Then you're going to just divide the stop size, the position size, and work out, hey, it's the same type of trade. And then the same with your ultimate target, whatever you can do. So the normal rules apply for that type of thing. Now, the other thing you've got to be careful of is, when you're trying to trade like a mean reversion type move, in other words, this would be classed as mean reversion. If you're kind of fading a down move, that would be classed as mean reversion. And very often it's tempting to come in when there hasn't been a low put in. So you think that's low, it's low, it's low, and you're trying to trade an exhaustion trade. And that's a valid setup in its own, there's no doubt about it. However, in the current conditions, we're getting exhaustion after exhaustion after exhaustion after exhaustion, and it's almost like it's nowhere near the same strength as it has been before. So if you are going to take what you believe is an exhaustion trade, then again, use the same kind of rules. So let's say we've had a move down, imagine we've got the candles here, you had a move down, and then finally you get the kind of exhaustion move that you're looking for, which is that wick. Now, I'm not saying this is the right or the wrong thing to do, but let's say you took that and you took up the close of the bar, you've still got to use the same concept of, okay, well, if it's genuine exhaustion, we shouldn't end up going back through the low here. So it's similar to this, except I've got a different frame and reference point. Same type of thing. The width is going to be determined by the distance between there to there. That's the order of magnitude, and your position size is going to be adjusted. So we're using the same type of thing. Now, one thing we have got to be careful of is when we're using, and these are fine because we've got predefined levels, right? We know that we've just got predefined levels. We just take X minus Y, there's our stop length. Now, what about when we're trying to have it in an area where we hope it won't get tagged? So in other words, let's say we don't have a defined area like that. Let's say we're taking a pullback trade. Imagine we don't have that yet. Actually, we're taking a pullback trade and we're kind of, timing the trade. Maybe it's popped up a little bit and we're long here, okay? Where would we put our stop? Now, normally we're going to make a judgment on how much range the market does and put our stop. We're not going to put it kind of 10 ticks. We're not going to put it 100 ticks. We're going to probably put it, depending on what market we're trading, somewhere in between that. We're going to have a look at, see how big was the rally. And if we look at it and go, oh, that's a 100-point rally. Okay, fine. How big is the pullback? Oh, it's a 40-point pullback. Right, well, if I had a 25-point stop and put me to kind of here, that's probably about right, because I don't want to come back too much. It's not really the trade I want. I want this 50% retracement type trade, revisit the highs. You get the idea. So again, the order of magnitude just has to increase. So rather than using a 25-point stop, you'll still look at it and go, okay, well, that was a 1,000-point rally. It was a 400-point pullback. Right, I need a 250-point stop. So the key here, guys, is to just look at the pattern still and still make your judgment on your stop position, even if you don't have a definite area like this, based on what you would do, and then look to the numbers around it and adjust and tweak your position size accordingly. The danger of we can easily fall into is we're so conditioned to a kind of an anchor stop or an anchor kind of target that we use if we're regularly trading one asset, that we can kind of use that as a reference and go, oh, hang on, 250-point stop seems a lot, but we're just trying to adjust for the order of magnitude increase in volatility. So, normal rules apply when our stops are on normal technical areas. When we're trading and we don't really have a technical area to work on and we're just trying to put it outside the noise, again, similar rules apply. Just looking at the kind of range of the market, even if that's a day or a week or a month or an hour or the move, however you use a reference point, and then working back from that and go, okay, average true range is that, average kind of 1 day bar is this, average 5-minute bar is this. Okay, now I need to use that as my kind of seed for the stop to come out from there. So, there's nothing revolutionary and different and difficult. It's just that we've got to be mindful because we're so conditioned to conditions where, okay, they might increase the volatility a bit and come back and down. We get this rotation of volatility. We haven't had this type of scenario for a long, long time where we've just got a massive explosion of volatility, a massive explosion of range. And we have to make sure that we're keeping our risk framed and reference point framed according to the quantity of the move rather than what we think is going to happen. And that's easier said than done. I know, because we fall into autopilot quite a lot, but maybe add as a checklist. Where's the risk on this deal? Where's the risk on this trade? Where am I wrong? Where do I want to come out if I'm wrong on the chart? Then look at where it is in an actual kind of points perspective or price perspective, and then work out how much you want to risk per trade, and then work out your position size, and you're good, and you've got your risk managed, and you're trading it regardless of how big the moves are. You're not going to get whipped out by noise. That's the easy thing that just kills so many traders in this market. Constantly trying to take it with tight stops, bang, 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 get whipped out all the time, death by 1,000 cuts type scenario, account balance just getting decimated, and you're getting frustrated as well because many of them would have worked out if you're just giving them a bit of room. So give the trades room, give the trades a normal room that you would normally apply to that specific trade, and then just dial down the position size accordingly. All right, guys, widening stops, or how wide to put stops in current conditions. Take care, keep the risk managed. I'll see you in the next one. Bye bye.